Imagine your household's primary earner is injured tomorrow and cannot work for a year or 2 years or ever again. Your monthly income stops. Your mortgage payment does not. Your car payment does not. Your grocery bill does not. Your kids' school expenses do not. The bills that run your life keep running, while the income that funds them disappears. Now here is the part most people are not prepared for. According to the Council for Disability Awareness, 65% of Americans say they could not cover their basic living expenses for more than 1 year if their income stopped completely. And according to LIMRA, the life insurance industry's own research organization, 70% of American households are either uninsured or underinsured when it comes to the coverage they actually need. 70%. 7 out of 10 American families are one serious accident, one critical diagnosis, or one catastrophic lawsuit away from a financial outcome they are not equipped to survive. In this video, I am going to show you the 3 most dangerous insurance gaps most American families carry, the exact dollar exposure each gap creates, and the specific steps to close each gap, some of which will cost you less than $30 per month. Before we continue, everything in this video is for educational and informational purposes only. It is not insurance advice, financial advice, or legal advice of any kind. Insurance needs vary dramatically by individual circumstances, family situation, income, debt, and state. I am not a licensed insurance professional. Please consult a qualified independent insurance professional before making any decisions about your coverage. With that said, let us look at the gaps. Let me define what underinsured actually means, because it is different from uninsured, and understanding the distinction is what makes this problem so widespread. Uninsured means having no coverage at all. Underinsured means having coverage, but coverage that is insufficient to protect you financially if it is actually needed. The underinsured person believes they are protected. They pay their premium every month. They have a policy number, and if something catastrophic happens, they discover too late that what they have is not enough. According to LIMRA's 2024 Insurance Barometer study, the most commonly cited reasons Americans are underinsured include not knowing how much coverage they actually need, believing insurance is more expensive than it is, and putting off the decision because it feels uncomfortable to think about. Those are understandable reasons. But the financial consequence of being underinsured is not just an inconvenience. For a family that loses its primary income to death or disability without adequate coverage, the financial consequences can include losing the family home, exhausting retirement savings, and decades of reduced financial security. The discomfort of the insurance conversation is temporary. The consequence of avoiding it is not. There are 3 coverage categories where American families are most commonly and most dangerously underinsured: life insurance, disability insurance, and personal umbrella insurance. Let us go through each one. The first and most common gap is life insurance, and specifically the amount of coverage most families carry versus the amount they actually need. The standard rule of thumb you may have heard is to carry 10 times your annual income in life insurance. If you earn $80,000 per year, carry $800,000 in coverage. That rule exists for a specific reason. The purpose of life insurance is to replace the income that the deceased would have earned over the remainder of their working life, so the surviving family can maintain their standard of living, pay off the mortgage, fund the kids' education, and meet financial obligations without that income. 10 times income is not a magic number. The more precise calculation is to add up everything your life insurance needs to cover: years of income replacement at your current earnings, your outstanding mortgage balance, any other significant debts, estimated education costs for your children, and final expenses, and subtract the financial assets your family would have immediate access to after your death. The remainder is your life insurance need. According to LIMRA, the average American household that has life insurance carries approximately $200,000 in coverage. For a household with a $300,000 mortgage, 2 children, $50,000 in annual income, and 20 working years remaining, the actual coverage need at the 10 times rule is $500,000. The gap, $300,000. The consequence of that gap. The surviving spouse either has to maintain the mortgage and living expenses on a single income, which most families cannot do, or they liquidate assets, reduce their lifestyle dramatically, or both. For most healthy adults under 50, a 20-year term life insurance policy providing $500,000 to $1 million in coverage costs between $25 and $50 per month. Not $250, $25 to $50 per month. The LIMRA research finding that most underinsured families cite cost as the primary reason for not getting adequate coverage suggests a significant perception gap. Most people believe life insurance is much more expensive than it actually is. For comparison, the average American household spends more per month on streaming subscriptions than it would cost to adequately insure the life of the primary earner. But here is what nobody is telling you. The life insurance gap, as significant as it is actually the most commonly discussed of the 3 gaps we are covering today. The next gap is the one that financial advisors say they see destroy families most often, that most Americans dramatically underestimate, and that most employer benefit packages cover only partially. I am talking about disability insurance, and the numbers are going to genuinely alarm you. And if this is opening your eyes to something you have been putting off thinking about, subscribe right now. We release financial investigations exactly like this 3 times every week. This channel exists to surface the financial risks that most people do not discover until they are living them. The second gap is disability insurance. And I want to start with the statistic that changes how most people think about this category. According to the Social Security Administration, 1 in 4 20-year-olds today will become disabled before they reach retirement age. Not 1 in 50, not 1 in 20, 1 in 4. A disability, meaning an injury or illness that prevents you from working, is significantly more likely over a working lifetime than most people intuitively believe. And yet, according to the Council for Disability Awareness, approximately 51 million Americans who are working full-time have no disability insurance at all beyond whatever Social Security disability benefits they might eventually qualify for. Social Security Disability, SSDI, pays an average benefit of approximately $1,537 per month as of 2025, according to the SSA. For a household with monthly expenses of $4,000, a very common number for a middle-income family, SSDI replaces less than 40% of what is needed to maintain basic financial stability. Many employers offer short-term and long-term disability insurance as a benefit. The typical employer-provided long-term disability policy covers approximately 60% of your base salary. But there are 3 critical gaps inside even that coverage that most employees never read the fine print on. First, most employer disability policies cover only base salary, not bonuses, commissions, or overtime. For workers whose total compensation significantly exceeds their base salary, the actual replacement rate is much lower than 60%. Second, benefits from employer disability policies are typically taxable as ordinary income if your employer paid the premiums. A 60% replacement of gross income becomes a 45 to 48% replacement after income tax, which may not be enough to cover fixed monthly obligations. Third, employer disability coverage ends when your employment ends. If you lose your job or change employers, your disability coverage disappears, including during the period between jobs when you are most financially vulnerable. The solution is a private long-term disability policy that covers your specific income, is owned by you rather than your employer, and pays benefits that are tax-free because you paid the premiums yourself. For most professionals in their 30s and 40s, a private long-term disability policy providing 60% income replacement costs between $100 and $300 per month, depending on income level, occupation, and benefit period chosen. It is not free, but the alternative, relying on SSDI at $1,537 per month, is a plan for financial hardship, not financial stability. Stay with me, because the third gap is the one most people have never thought about at all, and it is also the cheapest to close. It protects against a scenario that could wipe out everything you have built: home equity, savings, retirement accounts, in a single legal judgment. And it costs most families less than $20 per month. That is the umbrella. The third gap is personal umbrella insurance. And for most people, this is the coverage they have never heard of or have heard of, but dismissed as unnecessary. That dismissal is one of the most costly financial assumptions in American personal finance. Here is what a personal umbrella policy does. Your auto insurance has a liability limit. Your homeowner's insurance has a liability limit. Those limits are typically $100,000 to $300,000 in liability coverage. A personal umbrella policy sits on top of those existing policies and provides additional liability coverage, typically in increments of $1 million, that kicks in after your underlying coverage is exhausted. Why does this matter? Because a serious auto accident, a slip and fall on your property, a dog bite, a teenage driver in your household causing a major accident, any of these can generate liability judgments that dramatically exceed the $100,000 to $300,000 typical in standard policies. A lawsuit resulting from a serious car accident in which someone is permanently injured can easily reach $500,000, $1 million, or more. If your auto policy covers $300,000 and the judgment is $700,000, the remaining $400,000 comes from your personal assets, your savings, your home equity, your retirement accounts. Personal umbrella policies provide $1 million to $5 million in additional liability coverage. And according to data from the Insurance Information Institute, the average cost of a $1 million personal umbrella policy in the United States is approximately $150 to $300 per year. Not per month, per year. That is $12 to $25 per month to protect $1 million in additional liability coverage above your existing policies. The coverage that most financial advisors describe as the single best value in the insurance market costs most households less than they spend on a monthly dinner out. And the percentage of Americans who carry it is estimated at less than 20%. Here is your action plan. 5 steps. Starting this week. Step 1. Calculate your life insurance need. Add your outstanding mortgage, any other significant debts, 10 times your annual income, and estimated future education costs for children. Subtract accessible financial assets. The remainder is your coverage need. Compare it to your current policy face value. If you have a gap, get a quote. For healthy adults under 50, use a term life insurance comparison tool at PolicyGenius at policygenius.com or Haven Life at havenlife.com to see current rates in under 10 minutes. Step 2. Review your disability coverage. Log into your employee benefits portal and pull up your long-term disability policy. Write down the percentage of income it covers, whether it covers base salary only or total compensation, whether benefits are taxable, and whether coverage continues after employment ends. If you have gaps, contact an independent insurance broker about a private policy. Look specifically for an own occupation definition of disability, meaning the policy pays if you cannot do your specific job, not just any job. Step 3. Check if you currently have a personal umbrella policy. Look at your auto or homeowner's insurance declarations page. If there is no umbrella listed, call your auto or homeowner's insurance company and ask for an umbrella policy quote. The annual premium is typically $150 to $300 for $1 million in coverage. Most insurers require you to carry minimum underlying liability limits on your auto and homeowners policies before they will issue an umbrella. Step 4. If you have dependents and significant assets, work with an independent insurance broker rather than a captive agent. An independent broker can shop your coverage across multiple carriers and find the most competitive rates for your specific situation. The National Association of Insurance Commissioners at NAIC.org provides a consumer help center and state-by-state licensed agent lookup. Step 5. Review all insurance policies annually. Every major life change, marriage, children, a new home, a significant raise, a new business, changes your coverage needs. An annual review takes approximately 30 minutes and ensures you are not carrying the same coverage you had when your life looked completely different. Free tools for your review. The life insurance calculator at lifehappens.org/insurance-calculator, the disability income calculator at councilfordisabilityawareness.org, and state-by-state insurance department contact pages at naic.org. Before we close, one final reminder. Everything in this video is for educational purposes only. Insurance needs are highly individual. The coverage amounts and costs referenced are illustrative. Your actual needs and premiums will depend on your age, health, income, assets, family situation, occupation, and many other factors. Please consult a qualified independent insurance professional before making any changes to your coverage. But here is what I want you to take from this. The 70% of American families who are underinsured are not reckless. They are busy. They are overwhelmed. They put it off because it feels uncomfortable. And then life happens, and the gap becomes real. You now know the 3 gaps. You have the calculation framework for each one. You have the specific tools to get quotes in under 30 minutes. And you know that a personal umbrella policy, the most powerful asset protection tool most families never use, costs less per year than one dinner out. The only thing that has changed between you watching this video and 10 minutes ago is that you no longer have an excuse not to know. If this gave you clarity on something you have been avoiding, subscribe right now. We release financial investigations exactly like this 3 times every single week, all free. And I want to hear from you right now. Before watching this, did you know you might be underinsured? Comment yes, no, or checking now below. I read every comment. I will see you in the next one.